When a national financial system operates on a legal framework that is over 6 decades old, the administrative friction eventually begins crumbling the entire structure. The Legacy Income Tax Act of 1961 was subjected to 65 major legislative overhauls. Through annual finance bills and distinct taxation laws, it absorbed more than 4,000 minor amendments. This fragmentation occurred because lawmakers continuously layered specific socioeconomic exemptions into the code. Provisions designed to incentivize exports, encourage savings, and promote rural development were written directly into the tax law, which systematically narrowed the overall tax base. Every new exemption created an edge case. These overlapping rules increased corporate litigation as legal teams debated the exact boundaries of every incentive. The resulting administrative friction required an enormous allocation of state resources just to process basic compliance. The sheer volume of these contradictory patches pushed the legacy code past the point of viable repair. The government determined that writing another standard amendment would only compound the technical debt, making a complete architectural teardown a necessity. The Income Tax Act 2025 operates strictly as a system refactoring exercise. It is a rewrite of the legal operating system, not a mechanism to change individual tax policies or alter baseline corporate tax rates. To execute this rewrite without destabilizing the economy, the drafting process was locked to 3 strict constraints. The text had to be radically simplified, existing policy goals had to be maintained, and the baseline tax rates had to remain exactly the same. In July 2024, the Finance Minister and the CBDT initiated an aggressive, multi-tiered drafting process. The CBDT is the Central Board of Direct Taxes, the official government body responsible for administering direct tax laws in India. They consulted industry bodies and international tax models to rebuild the text. This timeline details the sprint. The original bill was withdrawn August 8th. A select committee then injected 285 recommendations, and the revised text passed the Lok Sabha on August 11. This final milestone gives compliance teams their runway. The code becomes effective April 1, 2026. By refusing to debate new tax rates or policy shifts, lawmakers isolated the variables. This strict adherence to the 3 design axioms allowed the government to replace the legal foundation of the economy rapidly without interrupting the flow of immediate fiscal revenue. The most visible output of this refactoring is the massive quantitative reduction in the law's physical footprint. This graphic from the CBDT charts the exact statutory compression. The 2025 Act slashes sections from 819 down to 536 and compresses 47 chapters into 23. To maintain clarity, it integrates 16 schedules and introduces standardized tables and formulas. This compression was achieved by identifying and removing decades of obsolete text. Lawmakers stripped out transition rules for extinct programs and removed explanatory clauses that no longer applied to modern financial markets. The treatment of tax deducted at source provides a clear case study of this cleanup. Tax deducted at source, or TDS, is an enforcement mechanism where a certain percentage of tax is collected at the exact moment an income payment is made. Historically, rules regarding TDS were scattered across multiple disjointed chapters. In the 2025 Act, these disparate provisions are stripped from their isolated locations and grouped entirely under a single, unified legal umbrella, Section 393. For corporate tax planners and chartered accountants, this physical compression directly translates to thousands of hours of administrative time saved. Lowering the search and interpret time reduces the back-end overhead required to remain compliant. Beyond restructuring chapters, the 2025 Act eliminates the legacy accounting terminology that defined how time itself was measured within the tax code. The 1961 Act relied on a dual-year system, requiring taxpayers to navigate the previous year, the time income was actually earned, and the corresponding assessment year, which was the subsequent period when that income was evaluated and taxed. This staggered architecture forced filers to constantly calculate across overlapping timelines, causing routine confusion and frequent filing errors. The new Act abolishes both terms in favor of a singular, modernized concept, the tax year. The tax year is legally defined as a continuous 12-month accounting period beginning precisely on April 1. Erasing this linguistic ambiguity closes a major psychological gap for filers. By directly aligning the act of earning capital with the timeline of reporting it, the system lowers the barrier to voluntary compliance. While much of the Act focuses on culling old text, it simultaneously builds new legal scaffolding to capture modern technological realities. The legislation introduces explicit, modernized definitions for virtual digital assets. A virtual digital asset, or VDA, is a legally recognized digital unit of value generated through cryptographic means. The 2025 Act scales the scope of this definition far beyond standard cryptocurrencies like Bitcoin. The legal boundary now captures entirely new digital environments, regulating data on cloud servers, the exchange of tokenized assets, and property rights established via cryptographic ledgers. To govern this expanded digital base, Section 532 of the Act grants the central government the statutory authority to design digital-first administrative schemes. The core directive of Section 532 is explicit: utilize technology to eliminate human-to-human interface between the taxpayer and the government assessor. This future-proofs the collection apparatus against emerging asset classes and transaction methods. Formally defining virtual digital assets and mandating faceless assessments addresses specific points of administrative friction. By removing localized human contact, the system reduces the primary opportunities for bureaucratic manipulation. The ultimate objective of the 2025 refactoring exercise is a systemic reduction in multi-year litigation and dispute resolution bottlenecks. The mathematical tax liability for corporations and individuals remains exactly the same as it was under the 1961 Code. The actual percentage of capital you owe the state has not shifted. Instead, the state realizes its return on investment through indirect savings. By simplifying the rules, the government spends less capital enforcing them. The overall cost of compliance drops for everyone involved. Corporations spend less on administrative interpretation, while the state requires fewer resources to audit and process returns. The Income Tax Act 2025 aligns India's primary revenue engine with global best practices. By prioritizing a transparent, simplified architecture over legacy legal complexities, the state aims to reduce the total administrative burden on the economy.